Well, howdy there, folks. What you're looking at in front of you right there, that is the most important stock market indexes, S&P 500, the Nasdaq, the Russell 2000, as well as the most important stocks in the stock market, Nvidia, Apple, Microsoft, and as well as Tesla, which is always big for market sentiment over the past 2 months. And what do you see? We're going to speak about that in this video. We're going to talk at the front of this video about my opinions on this. I want to kind of just react to this 2-month chart here and share my opinions and perspectives on where the stock market is about to head from here. From there, I want to react to some videos up here. All these are in regards to kind of the economy and the stock market related and where things are heading here over the next number of months. The U.S. could go a decade with no recession, says Ed Yardeni. That's a big statement there. So looking forward to reacting to that one. Morgan Stanley's Mike Wilson, who was notoriously bearish while the market continued to go up the last couple of years. Markets are likely to be choppy for the next 3 to 6 months. Looking forward to reacting to that one. The market that has been churning under the surface, Chris Verone, looking forward to reacting to that one. And then last one up here, markets are increasingly vulnerable to a correction, says Goldman Sachs. So looking forward to reacting to that one. By the way, I appreciate everybody joining me as always. Thanks so much for being here, folks. All I need from you, one thing only, can you do it for me? Can you do it for me, please? And it is smash that thumbs up button. That's all I need from you. I hope that's not too much to ask. If you want to be subscribed here, you can certainly subscribe. We are on the path to 100,000 subscribers on this channel. At some point this year, it's going to happen. You guys hear about this story? This lady is trying to sue Lyft because they didn't give her a ride because I guess they said she was too big or something. And
nice to meet you, Keys.
Got it. Yep. It's the only seat y'all got?
What you want? What you need?
There's one more. A bigger chair or something.
Is she already little? Sure.
Folks, if you're ever trying to sue a big company, don't get caught on film doing something that's going to hurt your case, okay? That's all I want to say to y'all, okay? Alrighty, 1000xstocks.com, massive sale coming up. Pinned comment down there if you're going to want access to that sale. You can get the deal via email or via text, however you would like it. It's going to be 1 day and 1 day only, Valentine's Day. That is for full access to the entire research platform, the search feature, the compare feature, where you can compare 3 stocks against each other, the earnings calls tab, the SEC filings, as well as our projections tab, and we're hoping to have our advanced projections up hopefully on Friday. That's the goal. The goal is to have advanced projections up on Friday. We're going to see if the team can finish that out here very soon, as well as access to financials, our beautiful charts feature that I absolutely love. As well as our entire education portion, which I know a lot of you guys, especially if you're in your first year or two of investing, this section is going to help you out immensely. These go very in depth about each subject. That is going to help you phenomenal. So once again, that will be a 1 day only sale, Valentine's Day. You want the deal? Pin comment down there, click on that, enter in your email or your phone number, and we'll send over the deal when it drops on Valentine's Day. Okay. Alrighty. Where do I think the stock market is headed? So here's the thing with the stock market. It's clear as day the stock market is just churning and kind of not really doing a whole lot of anything, right? Over the last number of months here. And we're kind of just like in this no man's land right now, even though earnings came out. Here's the thing about earnings, and here's why the stock market hasn't already started to go up. Earnings were not quite strong enough. Listen. Here's the reality of what happened this earnings season, okay? Now, keep in mind, earnings season is still going on, but now it's for a lot of the smaller companies. They're going to be reporting over this next few weeks. The big dogs have already reported, like the Mag 7 types, right? NVIDIA reports late, but all the rest of them have already reported. So the bulk of earnings season is done. The banks are all done. That's all done, right? The reason the stock market hasn't started to rebound is we have a problem. The problem is these companies' guidance, it wasn't quite strong enough. Companies' guidances were a little light, especially from a lot of the big tech companies. And so that leads the market to kind of be like, not feeling great. If we would have come in and all these companies would have beat their revenues and beat their earnings per share like many of them did, but then had a super strong guide in the back of that, the S&P 500 and the Qs would already be moving up substantially. You'd already see stocks like Apple, Microsoft, Meta, like go through the whole Mag 7. You already see all those stocks moving up significantly. Nvidia would be bouncing back strong, right? But because the guidance from these companies was meh, and some of these companies even had guidance that was below where analysts were at, it leads the market to still kind of be even more uncertain, right? So the market's clearly gearing up, in my opinion, based upon the price action, to make a pretty outsized move. It's just a question of, is the move downward or upward? Now, my hope is this market is grinding its gears here to get ready to make a very nice downward move. And you might say, why is that? I have millions and millions and millions of dollars invested in the stock market. Listen, I'm a buyer of stocks every single week, right? Also have a significant amount of cash on the sidelines. I would much rather have the market go down short term. I'd much rather gear up for the S&P to move down 5, 10, 15% and have a nice size correction here versus go up, right? Like, I'm buying stocks. I don't need my portfolio to say a new all-time high every single day. Like, that's cool if it does that, and it's been doing that for a while now, but I don't need that. I'd much rather buy stocks for cheaper prices. Would I rather buy AMD at 100? I'm going to probably buy AMD this week, for instance, right? Would I rather buy AMD stock at $110 or $10? $10, of course I would, right? Like, and you could say that for every single stock in the stock market. So my instinct is always to want the market lower in the short term, right? Short-term pain for long-term gain. Now, with that being said, do I believe the stock market is gearing up for a lower move? My personal belief is the market's actually gearing up for likely an upward move. But there's one thing we need out of the way. That's tariff stuff. This tariff overhang is really kind of working against the market right now because people are uncertain about what's going to happen here. What's Trump going to do? Are we talking about stuff coming against Canada and Mexico again here soon or not? What's going on with China? Are we talking he's going to levy a big new tariff on China across the board? So we just need a little more clarity in regards to tariffs. If the market can feel more certain in regards to the tariff situation, right, then we could talk about the next upward move for the stock market. But the tariff stuff is causing drama. And the reason it's causing so much problem right now is not only because of, that disrupting business models and supply chains and things like that, but it's also how it could disrupt inflation. Because if all of a sudden all these tariffs are going on, right? Let's say that was to happen. Naturally, it's certainly going to be inflationary, at least in the short term. You could make a debate about are tariffs inflationary over a 5 or 10 year span. That's a whole different debate. But there's no question that tariffs are inflationary over at least a 1 to 2 year span. And if there's one thing the stock market can't have in the next 1 to 2 years, it's another bunch of inflation. Because if we have another bunch of inflation, another batch of inflation prop up here, then that means, give up on rate cuts. And we could be talking about rate hikes again. And that the stock market would absolutely throw a fit if that were to happen. So we can't have that. No bueno. Additionally, the consumer is not in a strong enough place right now, at least in my opinion perspective, to have another major batch of inflation. So this is why we got to get more clarity on the tariff situation before we can make our next nice upward move, where the stock market moves up very aggressively and you see stock after stock just going boom, 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 upward, 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 right? So that's what we need to happen. And my guess that will happen. The time has to pass, right? We got to have some more time pass to really get through in that whole situation here. I'll leave up TradingView while we react to all these videos here. So let's go ahead and let's do some reactions.
Of Yardeni research, I love the optimism. Ed, you think it's possible we just let the good times roll right into the 2030s?
Well, look, Brian, I think the economy just demonstrated its resilience, right? Over the past 3 years, we've had the most widely anticipated recession of all times that didn't happen. It was a no-show recession. And I think it demonstrated that even with the Fed raising interest rates aggressively, with some of the geopolitical issues that challenged the global economy, and despite all that, the economy grew. There was no recession. And I think we have to kind of take that into consideration, that maybe
something really interesting happened today. I think it might have been Lindsey Graham said to Jerome Powell, he said, did we have a soft landing? And, we had a soft landing. Would you say we had a soft landing? Jerome Powell said, I wouldn't say we had a soft landing. He says, well, did we have a hard landing? Are we in recession right now? And Jerome Powell said, absolutely not. And he said, well, I would call it a soft landing. Why are you not taking credit for that? Everybody else in Washington would take credit for that. Here's why Jerome Powell can't take credit for a soft landing or not. The game is never finished. When you're running the Federal Reserve. The game is constantly going on. This is not like you win the Super Bowl and you can go out and celebrate and then you can call yourself Super Bowl champions for the next 6 months. It's not the way this works. The game is constantly evolving. If the Fed wants to, declare victory and then sit back and relax, that's right when things start to go really bad really quickly. You can't do that when you're on the Federal Reserve. It's an everyday game. It's an every week game. You got to show up for that game. And it's never technically won, and it's never technically lost either. It's just evolving. If Jerome Powell wants to sit back someday when he's retired, and his retirement might be coming in the next year or so, and say victory then he would probably feel comfortable more doing something like that, right? But not right now. Not right now. You can never declare victory. The game is ongoing every day.
Economy really is resilient. We just had some upward revisions in the labor market that showed that the labor market has actually been very strong and resilient. Unemployment rate remains around 4%. So far, so good.
But here's the dirty secret. We're learning this in Germany, right? And the German economy is not good. Costs are higher, but their stock market is well outperforming ours. This year can show the disconnect between economies and stock markets. So if our economy, Ed, remains strong, and we all hope it does that necessarily mean the stock market will also remain strong?
Well, Germany has a lot of conflicting developments. Their economy looks pretty weak. They're competing with China. China's literally eating their lunch when it comes to car production. So they've also got a really messed up transition from fossil fuels to clean energy. We have our own challenges, but overall the economy is doing extremely well. And I think it's going to generate earnings that will drive the market higher. I wouldn't really want to see the market go higher on valuation because valuation is already stretched.
True.
But I think valuations at current levels actually can be justified if investors are kind of looking at the economy the way I am, and that is it's just proved its resilience. Why can't it continue to be resilient and grow? If that's the case, we could be looking at a fairly long period of economic growth, earnings growth, and that's good for the market.
Ed, that was going to be exactly my question. The pushback that I hear from people is not about the stock market broadly, because you can look around and say, look, there's things happening in AI, there's innovation, but it's about the Mag 7 in particular, whose valuation isn't that wild, but they just think, everyone's in one boat. They're in the S&P 500, they're in the mega caps. There's no more buyers left, and, we're going to mean revert, and we started to see that in January.
Well, look, I have really no problem with this concentration issue that people are worrying about, that there's, the Magnificent Seven account for 30% of the market cap of the S&P 500. There's lots of other stock markets around the world where a handful of companies really account for most of the market cap of their markets. In our situation, these are credible companies. I mean, they don't have a lot of debt. They're generating a lot of cash flow. They are able to buy smaller companies with technologies that they can leverage up and make them world-class technologies. So I don't really have a problem with that. I also don't have a problem with the Magnificent Seven resting for a while and for some kind of regrouping where investors put more money in the S&P 493, which on a relative basis are cheaper, and they'll probably get a lot more benefit of AI than even the Magnificent Seven.
But you wouldn't see a reason to, avoid the S&P, kind of the classic, to kind of double down on small caps or go international or whatever.
Well, I've been recommending an investment strategy of stay home as opposed to go global since 2010. I mean, at some point I will probably overstay my welcome, but it just has worked for a very, very long period of time. As Brian said, Europe, at least on a short-term basis, has outperformed, but I think the trend is America continues to be a much more diversified, much stronger, much more resilient economy than most others, and I think that's what's reflected in the stock market.
Yeah, and I've said this before. If anybody wants to know my views on investing international or investing, let's just call it outside of the United States of America, don't. It's just not worth it. At the end of the day, Europe is just plagued with bureaucracy, plagued with a bad culture of innovation and whatnot, and that's why Europe continues to get just smashed when it comes to all the best tech companies in the world always are coming out of America, right? And just Europe has very little to nothing to show for it, and it's because they have a very bad system that does not really, the thing is, like, Europe has so many brilliant minds, like so many extremely smart people in Europe, right? But they can never put together from a standpoint of creating massive, large, very successful companies because the whole system is screwed up in Europe, right? And so that's why you're not going to see a Meta come out of Europe. That's why you're not going to see an Apple come out of Europe or a Microsoft or any of these companies. You're not going to see Palantir come out of Europe. Like, it's just their system's bad, right? A lot of super smart people, but a bad system. If you got a bad system, a lot of smart talent's going to get wasted. And what happens with the best European talent? A lot of it ends up eventually coming to the United States, right? It's just the way it is. A lot of the most brilliant folks in Europe eventually leave Europe, and they come over to the United States one way or another, and they build businesses in the United States, or they work for large companies in the United States because they understand the system's not in a great place for success there, right? Then you can look at China. China's always got a great market in terms of, expansion, but they have problems with their system as well, where it can't be trusted. Even the Chinese citizens, many of them don't feel comfortable investing in the Chinese stock market. When the own citizens of a country don't feel comfortable investing in that thing, it's not good. That's not good. You're going to tell me as an American, I'm going to go invest in the Chinese stock market when the Chinese don't even feel comfortable investing in it? Come on. India's got great growth opportunities over the next several decades. I'm extremely bullish on India. But with that being said, I do not need to invest in India's specific companies or the Indian stock market. I could easily invest into a lot of American corporations that are going to be expanding their businesses rapidly in India over this next 10 and 20 years. So there's a lot of exposure I can get there. The Middle East is, really a have and have nots. The Middle East, many parts are very messy. We know that, right? That doesn't, everybody in the world knows that. But also the Middle East has a lot of big money at the top. And so if I want exposure there, I buy Wynn Resorts, who's building a massive property that's going to be incredible in the Middle East right now. And I can get exposure there. I don't need to, go anywhere else than that, right? And so there's always, I could buy Ferrari stock if I want to play, the Middle East and the money that's in the Middle East. Like there's other ways to play it outside of just saying I got to invest in specific countries or companies in a different country or in a different stock market index. It usually ends poorly, and that's why these stock market indexes in these other countries underperform the S&P 500 and the Qs decade after decade after decade. And so people say it's cheap. Guess what? That's the same thing the guy thought 10 years ago when he was buying into what you're buying into. 10 years ago, somebody was probably saying the Chinese stock market was cheap. He got fooled as well, unfortunately, and that's the same thing you're saying today. And the same thing the next guy will be saying probably 10 years from now. It's, if the system's not in a great place, none of it matters.
I also just wanted to ask you, I thought it was interesting that you kind of talk about ignoring Washington. And this week, it feels like the market is ignoring Washington. We've had a myriad developments that you could say are cause for concern, and they're just kind of being shrugged off. One thing people have said is, look, if they're trying to shrink the federal workforce or put more of those people into the more productive private sector, that's the trend to focus on in the longer run. Is that how you come at this?
Absolutely, and it's consistent with the idea that pay attention to the economy itself. Look how it's the headlines. With all due respect to what you do and what I do, we tend to focus on the macroeconomic policies, monetary policy, fiscal policy. Just spent a couple of hours watching the Fed chair in Congress. But the reality is the rest of us working stiffs are doing an amazing job of keeping the economy going despite Washington. And so, my conclusion is that, first of all, when it comes to investing, don't let your politics get in the way. The market goes up and has done well, whether it's Democrats or Republicans. And again, I think it's because the stock market, the private economy, the private sector continues to perform extremely well despite Washington, and I think that's an important thing to consider when you're investing.
All right, Ed Yardeni, looking ahead to the Roaring 30s.
So, listen, folks. One of the things you really got to keep an eye on when it comes to the economy, and this is something to keep a serious eye on this over this next year or two, and I want to keep preaching it, and I'll be preaching it past it next year or two. Keep an eye on home building. Home building stayed pretty strong, I would say, over the last few years, even though mortgage rates are obviously sky high. Listen, if things change there in regards to home building and prices, and let's say, demand dries up, it's not going to be good for the economy. That just produces so many jobs. So many companies make money off that if we had a major slowdown in home building next year or the year after something, eventually that would hit the economy pretty hard, in my opinion. And we could be talking about recession in that sort of environment. We haven't seen it yet, but it's something to keep an eye on. And obviously, if you're really going to crack down on illegals, I'm just telling you, not everybody that's building these homes is illegal. Is legal. So that means, if I had to guess, the cost of building a home is gonna go up even more over this next year or two, which is gonna make prices even more insane, which, eventually you get to a breaking point, right? And, the scissors are coming to cut that rope. Mike Wilson.
And he views a broadening in the earnings recovery as critical to his year.
And let me say something very important to everybody watching this right now. We're talking about the market and what might happen with the market, and, this could happen and this could go wrong. Don't let that deter you from investing in the stock market. We have a million worries. We're going to have a million worries next year. We're going to have a million worries next year and next year and next year and next year. Like, that's always the way it is. And so regardless of your opinion on if the market's going to go up or down, or if the economy is going to go up or down, or whatever it is, always invest. Every month, every year, always invest, always invest, always invest, right? I buy stocks every week, regardless if I feel like the stock market's going to go up short term or down short term. All I know is long term is going up a lot, right? Whether I feel like, the economy is going to be good or bad or okay over the next year, it's all irrelevant. All that matters is making sure you're consistently buying and building your portfolio stronger and stronger in stocks that you believe in heavily over the next number of years.
S&P price target of 6,500. We are happy to welcome back Mike Wilson to Squawk Box. He is Chief Investment Officer, Chief U.S. Equity Strategist for Morgan Stanley. It is great to see you after quite some time. Nice to see you, sir.
Yeah, good morning.
So you think the next couple months are choppy. Does that mean don't do anything and wait for some kind of dip based on this sort of longer-term arc you've got going?
Not at all. I mean, we made that call back in November, December, just saying, look, we priced a lot. 6,100 was kind of our short-term target. And look, there's a lot of news coming out, and we think the growth, so the policies initially are sort of growth negative, which is, immigration sort of enforcement, and of course the tariffs, and that's just a lot of noise. So we're just digesting that. Plenty to do underneath the surface. I mean, financials have been phenomenal. We've seen it broadening out to some degree. In fact, software over semiconductors has been a great trade for us because as
software over semiconductors,
right? Because of the fusion of tech now and the application layers being built out, and we think that got confirmed a bit with the DeepSeek, announcement. So,
do you think that the semiconductor game is taking a pause, or it's over, or what?
Well, it has taken a pause. I mean,
I know it's taking a pause, but is it forever a pause?
Of course not. I mean, it's a cyclical group. And look, away from the AI beneficiaries CapEx has been pretty weak for most other semiconductor type spending.
Right.
And of course, now with this DeepSeek potentially leading to the next excitement part of AI, which is the diffusion of it in the application layer, that's the opportunity, is going back into the software stack.
Like, there was a time where you were worried about, I think, earnings, which could forecast a slowdown in the economy that could have been the R word, could have been a recession. That never happened.
That's right.
Have we learned to manage the economic cycle where it doesn't have to? Are we closer to it happening now because it didn't happen, or does it not have to happen unless there's a mistake?
Well, I think a couple things happened last year. What we missed is, we didn't miss it, but we actually called for it, which is a rolling recession. We've had recessions in many, many industries. If you think about the last 2 years, we've been in a recession in housing, in autos, in manufacturing, in consumer goods. A good part of the economy has been.
So we're not closer to that inevitable day of reckoning for something happening.
No, I will say this. I think what could be interesting this year is you could have a recession in government, right? If you have a recession in government, that may actually cause unemployment to go up to a level
that could cause a recession.
That's right.
Economy, yeah.
But it may not be that bad, Joe, for the rest of the economy because they've already been in sort of this soft recession. So that's actually our bull case, is that the government shrinks. The crowding out stops. It allows the Fed to cut rates at some point, and the broadening out can actually happen. A lot to happen between here and there, but that is actually the bull case.
God, that was like a symphony to me, what you just described. Is it? And you think that's possible at Morgan Stanley?
Well, I think they're working on it. Probably the most underestimated part of the administration is DOGE. I think there's a lot of skepticism around this. But the reality is that's possibly the most bullish thing that could happen. If you could shrink the government in a way that,
it's the end of the free world in a constitutional crisis. I just heard Chris Murphy say that to me. I mean, I'm scared beyond belief. I'm scared to where there's nothing in my intestines.
Well, I mean, it's the most exciting thing I've heard in a while. Remember, in the 1990s, we had this great bull market. Now, the thing that really sparked that, in my view, was the budget deal that happened in '94. Okay, now, I'm not sure we can get to that kind of a balanced budget, but if we can make progress on that, it liberates the private economy. That's
and the crowding out that you mentioned.
100%.
It's interesting. I mean, that is a contrarian take, I think.
Why is that a contrarian take?
You've been giving me the other side all morning, or giving us.
No, that's not the contrarian take on the.
No, the contrarian take that the Doge could end up being a complete, almost a spring-loading effect for the overall economy is not what most people are thinking. That's what you're.
I think most people are very skeptical. Investors are very skeptical because look, it's hard to do.
What do you think the ultimate number is that has to get taken out for that to happen?
Look, we just need to freeze spending. We don't need to really cut a lot of spending. We're running so far above trend on actual expenditures. Let's just freeze it or at least slow it down. I mean, we're growing at a much faster rate than the economy is growing. That's the crowding out feature, which, by the way, has kept rates higher than they probably would have been otherwise.
I think that's why the long end is running up, and if we don't do something immediately, that will be the problem that pops up.
That's right. The back half of last year, we saw rates actually start to move up. I mean, that was our call, why we thought 6,100 was doable, is that, a Republican win, a Trump win was positive for growth, but maybe not so great for rates. But now the market is kind of second-guessing that and saying, well, maybe they can be successful here. We just don't know. Yeah. And it's going to be messy. That's why we think it's going to be choppy for another 3 or 4 or 5 months, because we don't know the answer to this. But this is the direction they're going.
Right. Is there places you would stay away from right now?
Well, I still think low-quality businesses are under a lot of pressure.
Low-quality businesses are always under pressure.
Not always. I mean, remember in 2021 when inflation was accelerating, those businesses
just think anything would move, right?
They did phenomenally well. And we saw a little bit of low-quality work in the fall when there was a grab for risk. So, in fact, if you go back to last summer, right, we were basically recession fears were kind of rampant. And then the Fed cut rates 50 basis points. Low-quality did really, really well in the fall. And so I think that takes a backseat again. So we're avoiding that type of stuff.
Yeah, I don't know if what was it?
One question related to your semiconductor view on the pause. Does that also extend to data centers in real estate?
Well, look, there's an AI CapEx deceleration going on. That's not negative growth in CapEx, it's deceleration. Mm-hmm. But stocks live at the margin, right? They live in the second derivative. Mm-hmm. And that's what I think, that's potentially what's been weighing on the space, whether it's data centers, electricity, utilities, things like that, to get a little overcooked. That creates opportunity in other areas like financials, where Moody had to move, big liquid group
So, I don't know if I really buy the whole thing about just kind of being negative on riskier stuff, right? Because you even look at like some of what was usually seen as the least risky, like, Apple, Microsoft, those sorts of stocks. I mean, past 2 months down over 8% there. So, yeah, I don't know if I completely buy that, but a lot of his sentiment I definitely agreed with there overall. Financials was the other thing I was kind of like, I don't know about that. I don't know if I love playing financials here. We could definitely have some major rate adjustments. Maybe if you look out 6-12 months from now, maybe not in the short term, but maybe if you look out 6-12 months. And also, I just don't know if I love financials at this stage in the economic cycle, right? Like, I think financials are a more enticing, exciting play when you're coming out of a recession, when you're coming out of some sort of really bad economic time. I think that's when financials can be pretty exciting. So I think, if you were getting into financials, let's call it in the back half of 2020, after we went through, obviously, the Rona crash and whatnot, I think that was probably a compelling time to get involved in a lot of those stocks. Additionally, I think coming out of the great financial crisis, I think that was a very compelling time to get in a lot of those stocks. So you have certain time periods where I think financials are really attractive from a multi-year perspective, like where you can play them for 3, 5, maybe even 7 years. I don't love them now, though, because I kind of feel like, I almost feel like you would have to do it more as a trade than an actual investment. Alrighty, next one up.
All right, we're churning. We're churning. We're churning, and there's some groups that you'd say what you call them unenviable because they're looking like not so healthy, and other groups look a little bit better. But it's all market internals at this point. Overall, 6,000 to 6,100. But we could be here for a while, given the political backdrop. Is that what's causing?
Well, I think that's right, Joe. And we have been here for a while. We've been here since the second week of November.
How about the S&P, by the way?
Yeah, this is a market that's been churning under the surface. There are certainly the strong parts here. The financials and the banks have continued to act great in spite of it all. I think that's certainly important to note. Credit conditions remain remarkably benign here. So I don't think the credit markets are really seeing anything too ominous or sinister out there. But then you juxtapose that with, frankly, tech has lost relative leadership here in a pretty meaningful way, and that's not a new story. I mean, tech peaked relative to the S&P back in July. So we're 6, 7, 8 months into that leadership change. The autos and the housing stocks, I think it's notable they haven't really responded to bond yields moving lower. So it is a very, very split tape under the surface. Not uncommon in a new term for the market to churn those first 100 days. So we're working through that. I think the big tells here, does credit deteriorate from here? I think if credit begins to deteriorate, it raises the prospect that maybe there's something more sinister playing out under the surface.
So if we get above, 100 days, this is typical after an inauguration. You say. If we get above the 6,100 area or resistance, what do you watch there? What do you want? You want a broadening? You want it to go back to tech?
Well, I think importantly what we need to see, and what's been anemic for basically 6, 7 months, is the momentum under the surface. We have not seen that big expansion in new highs. We have not seen the broadening out. I think if you're going to really believe a breakout above 61.25 that can carry you with some runway to 64, 6,500, you need to see the momentum, the internals really start to improve. I think importantly, as all this has gone on, though, we have not lost the financials. That is so key for us here, where if something really nasty is out there, I can't imagine Goldman or Morgan Stanley or Bank of America would be making new highs, and not just the U.S. ones. I mean, look at the European banks. They continue to work here. The Japanese banks continue to work. So whatever this market is dealing with and has been for the last couple months, it doesn't seem to be a financial issue, which I think is a really key point.
Meaning you don't think it's an economic issue or a weakness in consumers or businesses?
Yeah, and Becky, I think one of the things that's also along these lines, despite this kind of risk-off tone or tape the last few months, consumer staples have done nothing here. So if you're looking to staples to be the market's messaging that statement, the economy is on the cusp of some meaningful slowdown, you certainly haven't seen it through those stocks. I mean, aside from tobacco, which is basically one name, the staples...
Yeah, that's the thing. The market's not telling you it's scared of like, oh, there's a big recession coming or anything like that. The market's not telling you that. The market right now is telling you we're just uncertain. It's hard to get super bullish in the short term, which the market really focuses on really the next 3 to 6 months more than the next 3 to 6 years. The market's having a big time getting super bullish here because it's very uncertain about what's going on with tariffs and what that could do to inflation. And so therefore, we're in kind of this no man's land right now where stocks are having trouble going up in any substantial way, right? And that's what you clearly see with the S&P 500 and the Qs in general. And this is during a time period when usually the market does pretty well.
Off the playing field and remain off the playing field. We like to watch the discretionary versus staples pair, and we equally weighted, so it's not Amazon versus Walmart. I mean, that continues to make new highs. I mean, that I think has been as good of a market tell on how it perceives the economy as almost anything out there. That largely remains in nice hands.
So you claim, I can't confirm, but you claim you've been bullish on gold for 2 years, so we're seeing a breakout. And you actually say that who would have thought that the pet rock, which is a good word for I hear it used for Bitcoin. People call it a beanie baby or a pet rock. But gold really is a beautiful, distinctive type of rock, of an element, right? It's a pet rock. But it's outperformed, in your view, AI represented by the QQQ. There's some AI that's outperformed it.
Sure. But I just think it's pretty remarkable. There have been two stories running parallel at the same time. You have the AI story, the tech story, the Qs, which have been dominant for a long time. Gold has been just as good. If you look at gold versus Qs over the last month, 3 months, 6 months, 1 year, 2 years, gold's actually been better. So that's not to diminish what NVIDIA has done or what tech has done. I think it's to emphasize there's been this parallel macro story as expressed through gold that's been just as important in this environment.
So let me show you guys another major risk for the stock market. It is right here. Commodities. GSG, Commodity Index. Take a peek at that, right? Up about 6.6% in the past 2 months. You know, that's a major risk. And why is it a major risk? Because that's a risk to inflation, right? This is why the market's having trouble moving up right now. You have the tariff uncertainty and what that could do to inflation a few months out. And then you have commodities moving up, 6.6% in general over the past 2 months. And people start to worry about inflation again in the back half of 2025 and going into 2026, right? And the more worries you have around that, the more worries you're going to have around also potentially a recession. So this is very important. Everybody understands why this market is having trouble moving up. That's why, folks. That is why right there.
A warning that markets are vulnerable to a correction this year due to either further rises in bond yields or potentially data or earnings disappointments. That's a lot of reasons that this could happen. Peter Oppenheimer, Chief Global Equity Strategist and Head of Macro Research at Goldman Sachs, is with us this morning. Are you predicting this is going to happen, or are you just suggesting that this is a possibility that we should be considering?
Yeah, Andrew, it's more a possibility. Let me be clear. We're positive about the direction of equities. We're in an environment where global growth is strong, particularly in the US, and rates and inflation are moderating, and that tends to be good for risk assets. But when we consider how much they've risen in the last 18 months in particular, well into the 90th percentile of historical distributions, and valuations are high, they're vulnerable to any disappointment. And, we think a correction is possible. Certainly not a bear market, but a correction. And we've been recommending people sort of hedge and also to diversify to improve risk-adjusted returns.
Well, so here's a question, which is, we always have, viewers who write in, they say they got a little bit of cash on the sidelines, and they're always waiting when to put it in. Should they be just dollar cost averaging in or trying or just on some kind of regular schedule? And then there are people like you who come on the air, and invariably they say to themselves, well, maybe I should wait. Maybe there's something bad that's going to happen 3 months from now, and actually this is not the right entry point. What do you tell them?
Well, I think you have to put this in perspective. For people taking a medium-term view or a view through the course of this year, we are positive. We're expecting broad gains in equities, and we are overweight of equities in our asset allocation alongside bonds, which is another form of diversification. Timing is always, of course, very difficult, but I think it is important to recognise that investors have put a lot of emphasis on the good news that's coming through, and there is a lot of good news. And that always leaves markets vulnerable to disappointment when we've seen a big rise in valuations and a big rise in prices. So in the short term, tactically, there is risk, I think, of some pullback. Although that being said, the earnings season has been strong, particularly in the US. But directionally, we think that markets are going to make broad gains. But we would argue that investors should diversify both within the US market and across different regions just to get a better balance and reduce potential risks.
In terms of what tips the balance, what's on your list?
Well, as you said at the outset, I mean, it sounds a little bit obvious, but, bond yields are around 4.5%. There's still concerns about inflation. I think if bond yields were to rise much from here, given the higher valuation in equities relative to bonds, that could trigger a setback in equities. Alternatively, if we do get any loss...
Let me go ahead, let me pull up Trueflation numbers and see what's going on with Trueflation data. Alrighty, so Trueflation data actually shows we're looking pretty good here, right? Obviously, there was a significant move up in kind of Trueflation numbers here from September through December, right? But basically, since then, we've had kind of a complete collapse in regards to Trueflation's U.S. inflation index here. So, that gives a little bit of comfort there. Usually Trueflation numbers are, a little out there in front of the reality numbers that the government gives out.
Momentum of growth coming through in economies,
from what I found over time.
Having seen a very strong run of good data, that again, I think would just bring a little bit more risk into the market and push equities down moderately from these levels. But so I think it's really a combination of inflation, potential concerns, and slightly weaker growth. But to be clear, we're confident about the global economy and economic growth continuing at a positive rate, particularly in the US. And we are seeing interest rates gradually coming down. And when you have that combination structurally and from a sort of strategic perspective, I think you want to be positive on risk assets like equities.
So, this is one of the many reasons I love the compare feature on 1000X is it really puts it into, when you're able to compare several companies against each other, it really puts into context, like how ridiculous some assets are trading versus others, right? So you look at Costco, for instance. Costco's forward P is 56. 56, that's like a double up of where Meta's at right now, right? And I'm sorry, but Meta's just a way better business model than Costco. And it's not even close. Like, it's not even on the same stratosphere. And, like, it's wild to think Meta's trading at half the valuation. Costco is going to go through it, man. Like, they're either going to have a massive crash in that stock or it's just going to be dead money for many, many years. But that one's just waiting to break. It just needs a catalyst to break it. And I was trying to look into the whole DEI stuff because they're caught up into that right now. I'm trying to figure out if that's going to be a catalyst to break Costco. But something is going to eventually break Costco here and bring that stock into reality. And reality is like put it at a forward P of 30, 35, or even the 20s. And man, that's going to be a big downward fall. But anyways, intriguing. Alrighty, guys, appreciate you joining me as always. Thanks so much for being here. Valentine's Day sale on 1000xstocks.com will be pinned comment down there. And once again, that's for full service to the entire platform, including the education feature, which I'm telling you, a lot of you guys really need this education feature so you can get, up to a much higher level than where you're at on all these sorts of subjects. And you don't want to be in a situation where you're gambling money in the market, right? You want to feel confident going in, knowing what you're doing, be able to look over a company and being able to understand, why it's a good investment, bad investment, right? And just have a lot more knowledge than not having all that, right? So once again, that's pinned comment down there. It'll be one day only on Valentine's Day. And yeah, you can receive the deal via text if you want, via email if you want. And we'll have a monthly deal on it. And we'll have, I think we're going to do a 2-year membership. So whether you want just on a monthly basis or whether you want it on a 2-year basis, like the 2-year basis will certainly be even a better deal in the monthly membership. But whichever route you want to go, that's going to be there. Much love and have a great day.